Hello learners, welcome to Business Skill Unit, Module 5, Financial Aspects. I'm your unit facilitator, Mr. Stanley Onyancha. This module has 4 topics: business plan, business structure, business operations, and financial aspects. In this topic, this topic contains interactive learning content and continuous assessments in the form of multiple choice questions and true or false questions. In this session, we are going to learn financial aspects of a business plan. Direction is, by the end of this topic, you will, number 1, be able to highlight financial aspects of a business plan. Number 2, you'll be able to apply the knowledge on different financial aspects of a business. Direction is, let us look at the financial aspects of a business plan. Financial aspects of a business plan encompasses the strategic blueprint for fiscal management, encompassing revenue projection, expense forecasting, capital requirements, and overall financial viability of the venture or the business. Let us look at some of the financial aspects of a business plan. The first aspect is revenue projection. Revenue projection are forecasts estimating the income a business anticipates generating from its production, service, or other sources. These predictions are typically based on market research, historical data, industry trends, and the company's sales and marketing strategies. Some of the examples we have are product sale, service, contract, and subscription model. Direction is, I would like you to share with me why you think revenue projection is important to consider when formulating the financial aspect of a business plan by answering the following question. Why are revenue projection crucial when formulating the financial aspect of a business plan? A. They provide a basis for estimating income and guiding financial strategies. B. They are unnecessary and complicate the financial planning process. C. They solely focus on historical data without relevance to future business performance. And finally, D. They serve as a secondary consideration superseded by expense forecast and projects. Number 2, we have expense forecast. Expense forecast outlines the anticipated cost a business will incur to operate and grow. These costs cover various aspects such as operational expense, such as rent, utilities and salaries, marketing and advertising, research and development, raw materials or inventory, and finally, any other overhead cost. Other examples that you may have are operational cost, as you can see from the picture, and marketing expenses. Number 3, we have cash flow statements. Cash flow statements track the inflow and outflow of cash within a specific period. They provide a snapshot of how money moves through the business, including revenue collection, operating expense, investments, loans, and other financial activity. Examples are operating activity, investing activities, and as you can see from the pictures, we have the financial activities. Number 4, we have budgets. Budgets are detailed plans that allocate financial resources across different areas of the business. They serve as a roadmap for controlling spending, and achieving financial goals. Budgets can be department specific or cover the entire business and are essential for maintaining financial discipline, avoiding unnecessary expenses, and ensuring that resources are utilized efficiently. Examples are marketing budgets, as you can see from the picture of a sample marketing budgets, operational budgets, how much you need to operate a business, and finally, sales budgets. Number 5, we have profits and loss statements. Profits and loss statements, also known as income statements, summarize a company's revenue, costs, and expenses of a specific period, typically quarterly or annually. They reveal the business's ability to generate profits by deducting expenses from revenues. Examples we have are the gross profit analysis, as you can see from the picture, operating expenses breakdown. As you can see from the picture, we have raw materials at 20%, utilities at 44.9%, and depreciation at 12.9%. And finally, we have the net profit assessment. Number 6, capital requirements. Capital requirements refers to the funding needed to start, operate, or expand a business. Determining the necessary capital involves assessing costs related to equipment, facilities, inventory, marketing, personnel, and other essential elements. Some of the examples that we have are the startup costs. How much do you need to start a business? How much do you need to expand the business? How much do you need to expand and or even operate the business? Another example is expansion capital, as I've said, and the other one is project financing. Number 7, we have financial ratios and metrics. Financial ratios and metrics are analytical tools used to assess a company's financial performance, efficiency, and overall health. This includes ratios like profitability ratios, liquidity ratios, and efficiency ratios. Examples are the profit margins. You can use the profit margins to know the health of the business, current ratios, and finally, inventory ratios. Dear trainees, now that you have learned about the financial aspect of a business plan, identify whether the following statements are true or false. A. Financial aspects of a business plan includes only revenue projection and ignore expense forecasting. B. Cash flow statement track the movement of physical cash flow and exclude non-cash flow transactions. C. Budgets in a business plan serve merely as rough estimates and are not crucial for financial management. And finally, D. Financial ratios and metrics are irrelevant in assessing a company financial performance within a business plan. An assignment for this session: you are required to carry out an activity by performing the following tasks. Visit any business enterprise in your locality. Identify some of the advantages of understanding the financial aspect of a business. Note down the corrected information. And finally, what I expect from you is to post your answers in the class WhatsApp. Thank you.